welcome to the FEG Insight Bridge. This is Greg Dowling, Head of Research and CIO at FEG. This show spans global markets and institutional investments through conversations with some of the world's leading investment, economic, and philanthropic minds to provide insight on how institutional investors can survive and even thrive in the world of markets and finance. FEG's Approachable Asia 2020 event was originally scheduled for this fall in Singapore. It is an event where we take a handful of our clients for boardroom-style education and to meet with local managers. Well, that was the plan before the coronavirus pandemic hit. The good news is that through a series of podcasts, you can receive the same content and get to skip the 16-hour flight. Today on the Insight Bridge, we will chat with two of China's elite venture capital investors, Jenny Lee of GGV Capital and Tommy Yip of Unicorn. Topics include, where will the next Alibaba, Tencent, or JD come from? How do evolving U.S.-China relations impact initial investments and exits? Outside of traditional tech, what other industries or businesses seem most promising for VC? And besides China, what other Asian countries have evolving venture communities? This podcast is being recorded across different time zones in 3 different countries. Bear with us, because at times the audio quality is not up to the same standard we would expect, but the content is great, so hang in there. All right, big FEG welcome to Tommy and Jenny for joining us here today. We are here in the morning in Cincinnati, and it is evening over in Asia. Before we get going, let's have each of you briefly introduce yourselves. And ladies first, Jenny, we will start with you. A little bit of your background and GGV's background.
Hi, everyone. Very happy to be here. I'm Jenny Lee, partner at GGV Capital. We are a multi-stage venture capital firm, global insights with a wide perspective in investments in US, China, and we're starting to deploy in Asia as well. So we manage about close to $6 billion US dollar in EUM. And over the last 20 years, we've been able, to work with very early emerging giants like Alibaba, the Didi, Grab, both China, US, and Asia. So we've been front seat at the start of internet disruption in China, US, and now in Asia as well. So very happy to be here to share our perspective.
Well, thanks, Jenny. Tommy, how about you?
Yeah, so this is Tommy Yip, and I'm a co-founding partner of Unicorn Capital Partners based here in Hong Kong. We are a early stage venture-focused fund of funds platform that is exclusively focused on venture opportunities in China. So we were founded back in 2015 with myself and my partner, Gafei Lo. So 2 of us, we came from a 20 years of LPs investment background. And we are focused on both TMT and healthcare in China. There are 3 types of manager that we go after in our portfolio. The first type is what we call top tier managers, including names like GGV and some other early stage venture managers that have been around in China for a long time and have been producing consistent, outperformance comparing to many others in the market. And we call that, the top, 3 to 5% of the market. The other group is our bread and butter, which is the emerging managers, the up and comers. And this is kind of like, trying to find the next GGV, right? When Jenny, first joined GGV. And the third type is, micro VC managers. And we're probably the only institutional LP in Asia or China that is focused on these pre-A sub 100 million managers. And that's us. And thank you for having us on this podcast.
Well, that's great. And thanks for all that. And Tommy, we'll get back to you on micro VC at the end, because that's an area I've got to ask a question or two on. So as we're recording this, we were going to be with our clients in Singapore. So we do this event where we take our clients with us to get some boardroom style education, meet with local managers, and really focus on a few key topics. We're not doing that this year, and it makes me sad because after our event, there were a lot of other different annual meetings, and one of them was GGV's 20th anniversary at the end of the week, followed by Formula One in Singapore, which is just a great, great event. So, Jenny, if we didn't have COVID, what would have been the focus of your 20th anniversary? What would be the message that you were going to tell your investors?
Yeah, so, unfortunately, we're not able to do this in Singapore. But this 2020 is a special year. It's our 20th year anniversary investing US, China, and as I mentioned earlier, South Asia has the next emerging economy, the next billion users. So one of the big objective of having our 20th year anniversary in Asia is really to bring our investors, from all over the world, Europe, US, rest of the world and our CEOs from primarily US and China to actually come, get together in the Singapore Asia landscape to talk about what they have seen globally in their home country, and also, the increasing trend where business models are being learned and translated into different and localized business model. Asia in particular has been a sponge, right? Learning, the startups here, the entrepreneurs here have been learning vigorously from what has happened in the US, as well as what has happened in China in terms of, the consumer tech disruption and new business models. So it's going to be a 2-day great event where we have, marquee CEOs. A lot of our CEOs were preparing to fly to Singapore to join us. And along with that, we also had planned for experts, economists, political views around South Asia as the emerging, region. Unfortunately, we have to cancel all that, but I think that the good trends continue, the good learning continues, and hopefully, we can bring everybody together again, hopefully next year.
You're too kind calling 2020 a special year. I would use a different language to describe 2020. It's not it's not special in a good way for sure.
So I've seen, as a VC, I've seen 20 years of ups and downs, at least 6 cycles. I've lived through SARS in Hong Kong, went through Asia financial crisis, global financial crisis, like whatever crisis, it's different forms, different style, affects different regions, entrepreneurs. And I think our learning there is that you have to stay consistent, you have to stay grounded and focus on what's best, right? Funding the right entrepreneurs, enduring business models. And after every cycle, we've seen giants emerge, right? 03, Alibaba, right? And so every down cycle, we see this. 2010, 2011, you see Meituan, right? Which on the food delivery side, it's now huge, big multi-unicorn in Hong Kong. So I think that's the hope, right? The hope, the light at the end of the tunnel is that we suffer through this. We get, we help our companies to get better. And I can tell you, we are very hopeful that the next 2-3 years, we will see the next generation of leaders. The folks, the entrepreneurs who can survive this will be great.
Fingers crossed, fingers crossed. And I think that's an important statement. I mean, we're taking this much more from a U.S. perspective. And while there has been nothing like COVID-19 on a global basis, Asia has dealt with SARS, and we've had MERS, and we've had other issues. So it definitely seems that Asia has been much better prepared to handle this outbreak. And I guess maybe to pivot a little bit to Tommy, and I wanted to ask you, TMT healthcare, and more sort of on the healthcare side here, has COVID-19 at all changed your perspective on investing in healthcare?
It hasn't really changed our belief or perspective on a healthcare investment in China. But I think given the geopolitical tension between the two superpowers, we are becoming a little bit more careful not to touch anything that will be scrutinized by CFIUS in the US. But whether that is TMT or healthcare, we are primarily focused on domestic opportunities in China. Healthcare, I think, is probably overly, generalized, right? So within healthcare, you have, pharmaceutical, right, biotech, right? You have medtech, you have, healthcare services, and you have digital healthcare. And for us, right, as a active LP investing in early stage healthcare funds in China, we are still very bullish in biotech in China. And in this particular sector, there are some cross-border components. Whether you're in licensing a drug from a global pharma and try to go through, Chinese CFDA clinical trials and then, help distribute in China. But there are also other local opportunities that are emerging. And we're also very bullish about digital healthcare. This is probably one area that, to be honest with you, that we're more bullish than, biotech and others, because, we're going to talk about, valuation, and the valuation for biotech is actually, it's getting very expensive. But yeah, I think, to answer your question, we're still, very bullish on healthcare in China. And what COVID has done for the market, it hasn't really, impact our view and our, conviction on healthcare.
Yeah, Jenny, any follow-up on that, especially as you get to thinking about mega trends like digital healthcare? That seems to be an area that would, Asia would seem to be really ripe for a huge platform in digital healthcare.
Yeah, so I think historically, the health science or bioscience sector has not been a big vertical focus for us. What we have done is looked at how technology, how new product innovation has changed primarily, industries, traditional industries, right? More the TMT sector. But, as we think about healthcare, we always think about what consumers are going to do, right? What the end customers is going to do. And so in this respect, the segment or the profile of users that we are tracking is the aging population. In view of the fact that, North Asia is aging extremely quickly. If you look at China in particular, by 2025, you would have over 500 million of the population aged 55 and above. Right. So then the question is, now this is not a old population, right? They are getting into kind of the second or third half of their life, I would say. But this is a population that's grown up with the internet for the last 20, 30 years, with mobile phone, last 20, 30 years, huge disposable income, has mobile wallets. But, in light of all this discussion, right, about safety in the food, safety from just what you eat and how you live your life. I think COVID basically accelerated that emphasis and the awareness that, it's not, you do not wait to be sick to worry about health. You actually have to take this as a preventive measure. And so along the healthcare sector, we are not as comprehensive as what Tommy has done, which is breaking this down into few areas. We looked at it more as, tech versus health and then health versus tech. So the tech over health would then deal with sensors, would then deal with equipment where you could use the sensors and the equipment to collect data, and then with machine learning, AI to then leverage and learn from there to allow us to have better diagnostic and better analysis. I think that's tech over health. The health over tech then part is we are thinking a little bit more about nutrition. And so, what would population age 55 and above do, right? Like, are they popping pills or is it just better eating? How are they thinking about nutrition? How does that coincide with, say, traditional Chinese medicine, right? Some of the other alternatives in the market. And so there we maybe are thinking about domestic brands, maybe different ways of delivery. Instead of chewing pills, can you chew candy, right? That tastes and is filled with more vitamins. So I think the twist that we have then more be health over tech, but then focus on this emerging aging population and, their aspiration for a healthier lifestyle. So it's not just health. I think it crosses a little bit of the food as well.
Technology is definitely the lens that GGV views everything. And it seems that we are at I wouldn't say maybe Cold War, but a tech war between the US and China. How do you think about that? Do you have to think much more about, domestic and for the most part, I think a lot of Chinese internet has mostly been focused on China and Greater Asia and less so on the US. I mean, we've had TikTok, which is kind of it's huge, especially with my kids. But, other than that, I can't think of a lot of other technology, especially Chinese internet, that's penetrated. But does that change business models? When someone presents you an idea, do you have to say, no, we've got to be much more focused on, China to China or China to sort of Greater Asia? How do you think about this decoupling that we're seeing?
Well, I think it's two angles here. Right? One is, what's the role of technology in terms of innovation and new business models? And in light of this US-China tension, does it affect entrepreneurs in how they think about startup? So I think on the simple basis, on the micro startup basis, the answer is actually no. Right. So technology is not evil. I've been in technology my whole life, coming to 50 years. technology is not evil, right? It could be in the form of a chipset, it could be in the form of algorithms, it could be in the form of just combination of this technology to create new products. And so where we have seen companies and startups in US and China take it, it's really to leverage technology to create new products. And I'll give an example, right? So education tech is a big area for us. It's a flywheel sector that we have started to invest in 4 or 5 years ago. 4 or 5 years ago, I did not predict COVID, right? What I did predict is that technology is going to change how education content will be delivered to the mass population, right? And so there we were thinking of how technology can allow content to be brought online so that classes can be done online, the 2.0 model, without reliance on physical facilities. Then we were thinking about how technology can be used to create avatars, virtual, AI, right, to replace a portion of teachers, maybe not all, but a portion of the teacher's time, right, in interacting with kids. So that's what started us to think about it. So if you think about the world of education, technology is an underlying enabler, but the curriculum has to be localized and it differs, whether it's US, China, India, Indonesia. And so in this case, the tech is being used really to booster charge what I mentioned, right? In order to rely less on physical locations in schools, in order to take that over reliance on key, star teachers, right, who actually cannot scale. You want to be able to scale, maybe avatar the teacher, right? So everybody can use the services. So in that sense, it is still very localized productization of the ed tech services. The tech itself, though, can be quite universal in terms of how it's being applied. Now, does US-China tension change this? Well, the answer is no, right? I think schools needs to continue to operate even, despite COVID. Students have to study even if they're doing this at home. So I would say that what I have seen is a lot of cross-learning. I've seen our US entrepreneurs get on calls with me to figure out, right, when childcare centers are closed, what do they do, right? And because China came back, recovered in Q2, the kids went back to school, right? So, how do then startups who were serving and working with childcare centers get themselves ready for the case when US starts to open up as well? So I've had outreach from US entrepreneurs trying to figure out and learn, what has happened in China and how they can kind of stay ahead of the curve. I've had India entrepreneurs come to us and said, hey, live streaming is huge, education live streaming. Now, again, with all the children stuck at home in India, but bandwidth is great. Bandwidth is free, almost free in India today, and powered by cheap mobile phone. Thank you, Xiaomi of the world. The Indian entrepreneurs are also, coming in to learn. So we put all our entrepreneurs together, and they loved it because they can actually cross-share the practices and the learnings. So, this is just one example, right? We see it in other examples where businesses are being automated. So in the world of smart automation, robotics. So I would say that it's been 99% local innovation, leveraging off the technology. Where there is concern that has impacted those companies is not in how the tech is used, it's in how they go to market. Right. So if the startup was planning to sell their product international, then I think that they will bear in mind, right? Should they have a sales office in the US or in India or in Singapore or in Europe, or should they start with Japan first, for example? So I think it becomes a business decision in terms of how, they should partner, if they should, go out or enter different markets. So it's a little bit more tactical on market entry, less in terms of saying, because of the tension, we shouldn't be leveraging this technology. So at this point, we haven't seen that. Definitely, if you're using chipsets, then there is a lot more discussion around second source, right? So again, very specific, different module, but by and large, I don't think you can stop, that entrepreneurship spirit, where people are still trying to change the world around them.
Tommy, what's your view on technology and especially the role of China and the U.S. and these issues? Has that impacted any of your underlying investments?
No, I think, whenever there's a crisis, there are opportunities, right? And in Chinese, this is called, weiji. I think, a lot of, investors like to use this. So definitely, increasing, tension between U.S. and China, right? And on the surface, you see the news on, Huawei, SMIC and others, being, impacted. But if you look at, the opportunities that is created because of this tension, for somebody like us or our underlying managers, right? This is actually something that, we will be talking about at our AGM in October, but I'll just give you some preview to it, right? Is what we like about is this import replacement, right, phenomenon. And because of the fact that China knows that it can no longer, depends on the suppliers, right? That's the reason why we are seeing the government trying to put so much, capital and resources trying to build the supply chain from ground up, right? And that is actually created and is creating, I think, a very interesting opportunity set. For us. I mean, if you look at the semiconductor space, right? I mean, it's been around in China for 20 years, right? I think when Jenny, first started her career, right, that was the time when, everybody in China was investing in semi, right? A lot of investors with Taiwanese and Silicon Valley backgrounds, right? With domain expertise, right? To invest in semiconductors. But it went through a pretty long, down cycle, and now it's coming back. Right. But the problem is that there's no more, talents who actually understand this space right now. But there is a huge opportunity, for, tech investors, in this particular, space. Because in the past, 15 years, China was all about, to see or consumer. Right. And it's difficult, for you to, have a dedicated professional on the team just to look at, semicon. Right, because the guy who's sitting next to him may be doing 5 deals a month, and the semicon guy is probably doing 1 deal a year. Right, this is the opportunity that we see, right, which is a result of this U.S. China tension.
Yeah, that's great. I mean, so 2 things there I take away from both Tommy and Jenny. I love there's always an opportunity. It seems like right now, China needs chips, semiconductors. That's going to be a major, major lift for the government, and they're going to need a lot of capital. So that sounds like a great investment opportunity. And then I also love, Jenny, what you said that, yeah, there's governments, but entrepreneurs are entrepreneurs and people are people, and they're going to share ideas. And so even if the governments might be pointing fingers back and forth, scientists, business professionals, they're going to hop on the phone with you and others and share ideas. And I think that's a great, that's very encouraging, at least to me, that we can all, even if governments do politics, people can do innovation. That's what we need right now. All right, so technology is great, but man, is it pricey. So let's go talk a little bit about valuations. And Tommy, maybe we'll just stay with you. How do you get your arms around these sky-high valuations for technology?
This is, I think, LPs like to ask about, valuation, right? So I'm sure that, both Jenny and I, we've been around for a long time. And I can tell you in the past 20 years, it was not a single year that LP would say, oh, valuation is low. Has always been that, hey, valuation is high. What are you going to do about it, right? So I would say that, this is not new. We thought, 2020 is going to be a, great year for investment because there's a chance for an adjustment, right, for valuation, right? It turns out that, 2020 is going to be, I think, a really good year for investment. But valuation, right, actually came back a lot sooner than what we expected, right? So if you look at China, right, there was no activity for maybe 3 months. When we, start, going into, mid-April, things started to pick up. You got data that was very encouraging. The overall economy was, rebounding, and, many verticals were showing, very encouraging data. And, people started to, issue term sheets, closing deals for companies that have survived COVID and came out really strong, right? These companies are able to command a pretty high valuation. So I think there's definitely, flight to, quality among investors, especially growth stage venture, investors, right? So valuation is not necessarily cheap, but, given the quality of these companies, I think we can still make a handsome return, that justify, the risk that we take in, early stage tech in China.
Jenny, maybe for you, I mean, you guys invest along the way. You do venture, you'll do some growth equity. I mean, where do valuations, how are they different by stage? Or is this everything expensive right now?
I think that, so our approach to valuation is this. Valuation is relative. It's not measured by the point that you enter or make the investments. It's actually measured by when you exit. And so I think valuation is static, but growth is dynamic. I'll give an example. So when we invested in Alibaba in 2003, we thought it was a really expensive deal. This was 2003, right off the back of SARS. One of the early investors in Alibaba wanted to get out. They decided that China is doomed. They cannot even handle SARS and things are just not going to look rosy, no change, no growth. And so they decided to exit from the asset class. And so GGV in our Fund 1, we actually negotiated to buy the stake. Back then, Series B, Alibaba, 180 million. And we thought it was expensive. It was probably the most expensive deal on the market at that time, and it was secondary stake. And we went in, indeed, it was a tough time. Ali had to pivot. They had to do headcount reduction, learn to survive. And then, of course, voila, right? It grew. Then the second time we had to deal with valuation was around 2012, 1-2 years before the group IPO. And I think just before the subsidiary Alibaba.com IPO. Back then, our fund was into our 12th year. And so definitely we have to be thinking about exits. And at that time, we thought, PC internet, great. E-commerce, great. Looks like it's growing. Ali was already in the sub-billion, 10 of billion valuation back then. And so we thought, this is a great valuation, right? And given the fund timeline, we think that we may be leaving kind of a 2x on the table, right? Because they're already a category leader. How much can you expect e-commerce, right? In China, payments not as matured yet. And so we actually underestimated the impact of mobile, the impact of mobile commerce, the impact of how mobile will change payment to allow even more new internet users to get into this category, right? We sold thinking we left 2x on the table, right? I think we left probably 200x on the table, right? So now looking at GGV perspective, it was a good return, right? From 180 to when we exit. But if you think about it, you could have made returns along the way, whether you were in before the IPO or you buy in at after the IPO, even now, right, when they spin off and they're about to list Ant Financial. So what we don't have or information at the time was that when we look at valuation or static exiting at the discovery stage when they are like 1/10 their potential or 100 their potential, right? But you want to be in, so you have access, you have preemptive information, and then we can double down. And therefore, our larger funds would allow us to come in, continue to double down, even all the way to IPO, even after IPO where we can hold. So I would say, that's the reason why we have our multi-stage strategy to allow us to come in. And then secondly, obviously no need to pay up, right? If you are great, if you are sector expert, your entrepreneurs will choose you. Entrepreneurs are very smart. They want partners they can grow with. So beyond valuation, beyond that dilution, they are looking for partners who understand the sector, who can spar with them on where to go, which direction on product, which market to get listed on, what kind of new investors they should invite around the table. And so I think that it is still down to fundamental, right? The sector expertise, the value add to the entrepreneurs. And I think at the end of the day, with 20 years under our belt, it's also that brand recognition and the acknowledgement that the partners are there to help the entrepreneurs to grow. So we have to compete on other fronts beyond just the price tag. And I think that in maturing market or even mature market like US and China, trust the entrepreneurs. The best entrepreneurs, they are very smart. They do due diligence and they will find the best guys. And many times it is not the best price.
I think that is especially true post-COVID. In a market like, China, entrepreneurs are getting very sophisticated. And post-COVID, they're looking for brand and capital stability. And there are not that many, VC firms in China that are able to provide that. So I do believe that in the post-COVID world, top tier is going to have an advantage, because they have brand as well as, capital continuity. In venture, you want to make sure that, you're backing the top 3% of the market, whether that is 3% of the venture market in terms of, startups, or 3% of the managers market, right? You want to be able to not just get access into these top 3% of the market, but also be able to do your due diligence and make your judgment that these are the guys to back. So in China, it's a landmine. It's easily you'll be able to back maybe the rest of the market, which is the 7% of the market, right? So by investing, in a local firm like GGV, or partnering, with a local fund of funds like us, I think is critical.
I guess that's a reason for boots on the ground versus other firms that may kind of parachute people in when Asia's hot. You're both there. You live it every day. How important is that to get access in Asia?
Yeah, I think that, as a VC investing in the market, it's also very important to understand the change that has happened in both the markets, right? So in the first 10 years, when we were looking at China internet trends, you could still find a lot of parallel, right? Like what has happened in the US, you can translate that and see that happening in China, right? Whether it's on the consumer side, whether it's on the enterprise side, there was a lot of what I call translated model. And therefore, fly-in VCs who's expert in those areas in the US, when they come to China, they are also celebrated expert because there is that hunger to want to learn from those who have done it before. But I think after 2010, 2011, when mobile starts to take off, actually China, entrepreneurial landscape changes, right? Because the way the consumer uses mobile internet is actually very different, right? When the first users first come on board, it is their first device to the internet. Consumers start to play games, they behave differently. And therefore, the business model, after 2010, 2011, took on a very local characteristic. We have our own WeChat. We have the whole ecosystem of WeChat, right? Of course, you have Alibaba, and then the whole Taobao seller ecosystem, e-commerce on Taobao. And so unless you're in China, living, breathing the model and being users yourself, talking to the entrepreneurs, someone who hasn't spent that time experiencing the Chinese life, right, on a day-to-day basis, would find it very, very hard to understand, right? I still remember it when YY went public, and this is the early live streaming entertainment platform that went public in 2012 in the US. They had virtual gifting. There were users who paid 20,000 RMB for virtual BMW to show up on their screen, just so that when they are listening to someone singing online, they have this virtual BMW coming into the room. Like, can you imagine explaining that business model to the US investment community? Like, they don't understand because it is not a use case that happens in the US. So it takes another 10 years, right, for TikTok to show what the entire population in China has been doing for the last 5 years, which is, short video, sharing, right? So I would say because of that, it then becomes very, very important for VC firms, GPs who are serious about China, that you do need to have feet on the ground and not just living in your, ivory castle, but you do have to get grounded. You have to go down. You have to understand what the Diaoshi is doing, what the general population is doing. The consumer in tier 3, tier 4, they actually consume the internet very differently. And along that line as well, we are now seeing a huge enterprise wave, right? Enterprise wave has come, or innovation and startup has come about 5-10 years behind the US, right? But it is happening because the fundamental shift is happening. Today, we have cloud infrastructure, the Ali cloud, the Tencent cloud of the world. The infrastructure is set up. Amazon cloud is allowed in as well. And then on top of that, we have now standardized mobile devices, whether it's for consumer playing games or for enterprise, SMBs, managing workflow, approving invoices. So when you have the right internet infrastructure, cloud infrastructure, when you have common computing device, it actually means that, the so-called enterprise world and the consumer world, it's converging, right? And so in that sense as well, what we are now seeing is that, yes, the enterprise wave is coming, but in China, it's also taking a different form, which is because the workflow, right? How different SMBs, how different, let's say, construction site workers manage their workers, how, in hospitals, how they manage their their doctors and nurses, like all this workflow can be very different from a typical workflow any other country. And therefore, the type of startups that we see, even in the enterprise now, it's no longer about saying there's a sales force in the US, is there a sales force in China? Because it's not going to be a sales force in China. It may be a WeChat widget, right, that allows you to do checked in because you enter the building and therefore you need to be checked because in this COVID environment, you need to have your health declaration, for example, right? So I would say, consumer went on its way, went on its own way, and now we're seeing similar learnings for enterprise. But there's also a part of the enterprise tech in China that will go its way because of the very localized and different workflow as well. So if you're not here, if you're not using and not running businesses, it is so difficult to understand where that next, light bulb is going to go off and be the next great company.
That's a great answer, and thank you for that. And one of your earlier answers, you talked about Alibaba, and it used to be that a exit strategy was go to the U.S. first. Now you started to see dual listings. Will there be an exit that's going to be U.S. focused? Are exits going to look different, kind of going back to that U.S.-China tension, but just in terms of exits, are they going to be longer? And is it going to be star? Where do these venture companies IPO at in post-COVID?
Yeah, I think it's already changing, right? Given the geopolitical tension and the potential risk of delisting, for these Chinese companies that are already listed in the U.S. Okay, I think in the past, right, a lot of entrepreneurs, especially those who have received U.S. Dollar funding and have VIE structure, ideally, they will go for a NASDAQ or NYSE IPO. Right? But given the ongoing tension between the two countries, right now, I think the plan A has changed to more of a U.S. plus Hong Kong, right? U.S. being the primary listing and Hong Kong being the secondary listing, right? But that is also changing given the momentum in the domestic Asia market, and that the Star Board, right? This newly launched board that is trying to replicate the NASDAQ in the US, with a listing requirement that is designed for tech startups, okay, and it's shooting off the roof right now, right? And you can ask Jenny about one of their investments, WPS, right? It's just crazy. So to answer your question, right, with a different exit route in China or a dual listing of maybe what we call A plus H, Asian market plus Hong Kong market. Okay, the holding period will be a bit longer. Having said that, though, the premium that you can get by staying maybe 12 months longer is also a lot higher. The crazy PE ratio will come down, but still, I think when there are not that many high quality tech startups that you can actually choose in the domestic public market, those that are with high quality and are backed by top tier venture managers are going to continue get a premium.
So Jenny, when you're talking to your fund investors, are you telling them or giving them counsel on A plus H? Is that kind of one of the main focuses if they're going to go the IPO route? So what are you telling your portfolio companies?
So maybe I'll share a bit of a perspective in terms of the listing and markets. So our view is that the capital market globally, they are open to all types of startups and why, right? So over the last, right now it's September, so over the last 4 quarters, right? Over the last year, we've had 6 listings despite COVID. We've had 6 listings, so since Q4 until August. Of the 6 listings, 4 of them are Chinese companies. And the 4 Chinese companies, 3 of them chose to list in the US. The most recent one is our most recent IPO, XPeng, which is our electric car company, Chinese company, claimed to be a Tesla competitor. got listed in the US, right? So the other two companies, US companies, one of them did an IPO in a very traditional fashion, e-commerce. The second one chose to list via a SPAC. So I think number one, in terms of exit, we have seen a lot of options, whether it's a direct listing, whether it's listing via a SPAC, whether it's a traditional IPOs. We've seen that happen, and it's quite a bit, right? 4 quarters, 6 listings. Number one. Number two, of the 6, note that 4 are Chinese companies, and of that 4, 3 have chosen to go to the US. So the conversation around the board table is why, right? Like with all this tension, why are you still going to the US? Do you not face risk of delisting, being, ostracized, all that stuff? Now, the 3 companies that have chosen to go listing in the US, one of them is a super high-tech company that does autonomous flying planes. Okay, it is very suitable for NASDAQ. It's what NASDAQ was designed for. It is a world where really, kind of moonshot deals, right, can have a chance to get in front of investors and actually to get listing to fundraise. That's what NASDAQ was designed for. None of the Hong Kong or China exchange can deal with that, right? Because Hong Kong requires profitability. I think the Star Board is still trying to get its act together, and therefore it does want larger size companies, profitable, revenue growth, business models that investors can understand, right? So the first company decided to go to US is because the market makes sense, the right investors make sense. The second company that decided to go to the US goes to the market with a business model that says they are Zoom technology plus Twilio monetization. Perfect comparable, people understand it's a tech play, they are API core, they support all live streaming through API. Very simple business model, investors love it. A high recurring business model. The company has an international ambition and not just selling domestically, but also internationally. So from that perspective, the US IPO market is an ideal market for them because their customers like to know that the service that they are using to power, their streaming, right, their gaming, their education services is a company that's listed, and you can actually look at the numbers and actually trust the exchange, right? So that's the second company. And of course, the third one is XPeng, which is electric car, right? Where else to go but next to Tesla, right? on the exchange. Then I think the fourth company, WPS, chose to go get listed on the Star Board. So that's a company that went and got listed on the Shanghai Star Board November of 2019. At one point was the highest market cap company on the exchange. Of course, SMIC overtook them, and so they're the second highest. At IPO, we were sitting on 26x. Today, we're sitting on 50x, right? So I think that is the local market open? Yes, because everybody uses WPS in China. If you're Android users, you need word processing, you need Excel file. Like WPS is a household name, and it's an app that works very well in China, for China, a China household brand. And so it's like an index stock. They should get listed in China because it's where the target audience is, and it's where also, thanks to the accelerated market reform in China, the market is ready. So I would say that those are the advice that we will give companies, not just to push for dual listings. I think typically large companies has the ability to do dual listings, but if you're just a fledgling startup getting, even at $1 billion valuation, you may still be too small for dual listing, right? To be able to maintain that type of float liquidity. So I think Ant Financial, can do that. If Baidu wants to come back, dual listing is definitely the route to go. Xiaomi, right? Going back to China, Hong Kong, China, that will work. But I think for a lot of our younger startup on their first path, it is still to find a exchange that understands them, investors that understands them, and that they can, leverage it, the benefit of IPO, whether it's branding or for fundraising purposes. So market is not closed. It is actually open despite, all that discussion that's out there.
You heard it here, that markets are open. Well, that is good to hear. And I wanted to maybe ask, we've been talking a lot about China, and there's good reason to talk about China. That really has been the kind of the VC darling, and the Chinese internet companies have fueled all these other investments in all these other industries because a lot of money's been made. But Asia is very big. It's very big even without China. And so maybe I can ask you each, where are you seeing investments outside of China? Is it the ASEAN region? Is it India? Where are you guys seeing great venture-backed companies, great entrepreneurs? And maybe Tommy, I'll start with you first, and then we'll go back to Jenny.
Yeah, so we are primarily focused on China, and I can foresee that in the next 5 to 10 years, that will continue to be our main focus. Having said that, though, we are increasingly paying more attention to ASEAN, particularly Indonesia, which has a very sizable market, right, and other small emerging economies such as Vietnam. India, has always been on our map, right? I think there's a hiccup, right now because of the border tension between the two countries. But we are we continue to be very bullish about the long term aspect of the overall India tech environment. And right now, I would say that comparing to maybe 15 years ago when I first invested in India as an LP, the timing actually looks a lot better, right? I don't know whether that is the right timing, but it's just a lot better than last time when I invested in India VC fund 15 years ago. So that could be the time, and we are closely paying and increasingly paying more attention in these markets.
Jenny, how about you?
Well, for more insights on Southeast Asia, I also encourage all the listeners to download our very popular GGV podcast called The Next Billion Users, hosted by our very own Hans Tong. Actually, it does capture a lot of interviews that Hans has conducted with entrepreneurs in the region. And so they can also add a different perspective from India, from Southeast Asia, entrepreneurs from the likes of the super unicorns from Grab to some of the local super unicorns in India. So shameless plug there. So I think as you can see, for GGV, we follow the consumer. And therefore, in 2019, we make the conscious effort to reopen our Singapore office as a way for us to have more feet on the ground, more entrepreneurs, place for gatherings, for discussions to happen. And so right now we are allocating about 10-15% of our total capital to this region. It's two different regions, right? So one Southeast Asia, two India. So in Southeast Asia, it's a region that we have traditionally made investments over the last 15 years. It's actually a very profitable region for us. It's taken a while. We deployed about 200-300 million, and it's sitting at over 3x distribution, 2+X. And of that, we have a super unicorn Grab, which my other partner, Jishin, led. We came in at Series B, early stage, 40 million, 40, and today it's 14 billion. So I think that it's the playbook that we have seen happen in China, right? In emerging markets, you want to get there early, but don't go crazy, work with good entrepreneurs. And very important to make sure that the companies that we work with turns out to be, huge unicorn, right? Much as what we have done with Alibaba in China, it's really allowed us to then leverage that to get to know more talented entrepreneurs, and therefore as they, move on to look at new sectors and have new startups that we can come in to be part of the ecosystem. So I think in Southeast Asia, we have a decent track record, I would say, to date. But what we see in terms of opportunities, it's not broad-based, right? So we have actually looked at a lot of companies there, but where we have decided now to focus our effort is an extension of some of the flywheels and sectors that we have learned has worked very well, US and China. So in particularly 3 areas. One is education tech, right? As I mentioned, the model works very creative in China, can be learned and leveraged in markets like India and Indonesia. And so we use that learning to invest in the local leaders in both the markets, one in Indonesia and one in India. The other area is a different aspect. So we also spend a lot of time in what we call the digitization of the offline mom and pop. So if you think about China 20 years ago, when we first came to China, there was no online e-commerce, right? The shops, the retails were all offline. They were individual mom and pop. And then Alibaba, just like a yellow page, had their troops of people go knock on the door and said, let me help you do a website. By the way, let me tell you what a website is, right? Let me build you the website and you can advertise on these links, right? It's really like the yellow pages of the early days. Actually, we see similar trend. If you look at markets like Indonesia, Vietnam, India, they are still in that first inning, right? It is still very offline. It is still very mom and pop. And so for internet to work, you need to have a way to have structured data collected. And once you have structured data, that's when new business models can happen. The interesting change, and Tommy mentioned this, right, in India between now and 15 years ago, is that fundamentally there's been change, right? One, the internet is now almost free thanks to what Jio has done. Number two, again, I mentioned this earlier, thanks to the proliferation of cheap smartphone, you now can allow this unified high computing device to be in the hands of the average consumer in India for a low price. And then thirdly, in India, there is a unified payment ID, right? So when you put network and you put computing device coupled with a unique ID for payment, you have all the right ingredients to open up transactions online. And that's the reason why we've been tiptoeing and making investments in the market, of which I think education tech is one, because now you can actually have online streaming education content on your mobile phone and pay for it, right? And then two, digitizing mom and pop because of the device, because of the internet, even the mom and pop proprietor owners are using phones to track data. And so that's an area that we have decided to make investments. And of course, the third area is on the lending platforms. There in Asia, in emerging economies, we're very interested in payment infrastructure, right? How, can we have machine learning to do fraud detection? Because there will be fraud. In any early markets, when there's transaction, there's going to be fraud. And so that's the other angle on payment side, not so much on lending, but on how do you secure now the whole payment infrastructure from fraud to connecting the payment wallets. And so again, very specific in terms of how we're going to hunt in those regions. I think this region will take a while, maybe the next 10 years, 15 years, but the hotspots that we have identified, hopefully will emerge earlier because they are fundamental building blocks of what we think is the South Asia, kind of the next billion users, kind of the backbone. That's how we think about it. And I think that it will be a very exciting region, which is why our 20th year anniversary was planned to be here, which will come next year.
Maybe we'll celebrate on the 21st anniversary. We can kind of see all of it together. Hey, last question, and Tommy, I'm going to come back to you. And this is something you mentioned in your opening statement. Micro VC. What is micro VC and what does it look like in China?
Micro VC is not too different from what you guys call institutional seed managers in the US. In China, this is a term that we use because in general, these VC funds fund size is relatively small. Right? A lot of them are actually sub 100 million, and they are mostly focused on angel and pre-A stage. For example, we talk about import replacement. That is mainly in the semiconductor, space. Everybody knows that, this is an opportunity. But for the mainstream VCs, they may not have, somebody who's dedicated on that space or, having domain expertise, on the team, right? So they may, look for somebody who has that, but, investing maybe one or two, stages earlier at, angel round or pre-A round, right? So we are seeing in the earlier stage, groups are becoming more specialized. It's just very difficult, for a small micro VC or institutional seed manager to compete with, the GGV of the world in areas like consumer. You just don't have any chances to do that. So it's almost for a micro VC to be in existence, you almost have to become, what we call a KOL, key opinion leader, or domain expert in a particular sector, so that the top tier guys or the mainstream Series A guys will actually cherry pick on your deal, right, and lead the Series A round of some of your deals, right? So we are seeing a more specialization in the institutional seed, manager space, and the good ones tend to get quite a bit of attentions from the mainstream Series A firms who will try to collaborate with them. To a certain extent, they are like the feeder funds to the Series A guy. And that's why you will see, partners of the big VC, funds, themselves, sometimes will become a LP in these smaller, managers from a deal sourcing standpoint. This is a very interesting area because we think because of the early stage nature and and the relatively, smaller fund size. I mean, if these guys are able to do it, right, and become a domain expert in their own vertical and then be able to feed their deals, right, to the top Series A, players, that could be quite interesting, right? We do see the, potential explosiveness in their return.
That is great. And I just wanted to give a big FEG thank you to Jenny and Tommy. This was fantastic. I wish we were doing this in person, but this has been the next best thing. So thank you so much for your time, because I know you guys are so busy and we really appreciate it. So thanks again. Don't forget to subscribe to our communications at www.feg.com/subscribe so you don't miss the next episode. Please keep in mind that this information is intended to be general education that needs to be framed within the unique risk and return objectives of each client. Therefore, nobody should consider these FEG recommendations. This podcast was prepared by FEG. Neither the information nor any opinion expressed in this podcast constitutes an offer or an invitation to make an offer to buy or sell any securities. The views or opinions expressed by guest speakers are solely their own and do not necessarily represent the views or opinions of FEG.